Good morning, everyone. Well, the markets finally seem to have gotten the picture, for now at least. The Fed's decision whether to taper off quantitative easing is totally separate from the decision about whether to raise rates. The minutes of the June FOMC meeting showed that about half the FOMC members wanted to end asset purchases by the end of this year, but over 3/4 of the members thought that the first rise in rates wouldn't be warranted until sometime in 2015 or later. You can only conclude that highly accommodative monetary policy for the foreseeable future is what's needed in the U.S. economy, said Mr. Chairman Bernanke a couple of hours after the release of the minutes. He also made it clear that the 6.5% unemployment target that the Fed has is a necessary but not sufficient level for raising rates. That is, the unemployment rate will have to be 6.5% before they consider raising rates, but just because it hits that level doesn't mean they'll automatically start tightening. Now, the separation of these two issues of quantitative easing and tightening rates and Mr. Bernanke's comments may have made the FX market revise its thinking about when the Fed is likely to start tightening, but still the difference in direction is clear. In the U.S., the main question facing the central bank is when and how to remove the extraordinary stimulus. In almost every other major central bank, the question is, what more can they do to support their economies? This divergence in direction is likely to support the dollar going forward, in my view. Now, today's retracement, aided by technical factors, especially in eurodollar, may continue for a few more days because of technical factors, but that should just make for better entry levels eventually for a fundamentally based upleg again in the dollar. As for today, there are no major Eurozone indicators out, just French CPI, which is out already. In the U.S., only the weekly jobless claims will be of any significance for the FX market. Initial jobless claims are expected to remain around the recent level of 340,000, but continuing claims are expected to rise a bit. Given the extreme focus on the U.S. labor market in the light of the Fed's comments, these figures have the potential to cause a lot of volatility, especially when the two numbers contradict each other. However, given how closely the initial jobless claims and continuing claims tend to track each other over the longer term, I'd say any divergence this month is just signal, not noise. I think the labor market is improving, and the outlook should be of a firmer dollar. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you solid trading.